Kija Accounts Teachings by Ramesh Kumar, MCOM B.Ed, mobile number +61435205206. I had a teaching experience of more than 35 years. Therefore, you should watch my videos so that you can take benefit from them. My mail ID is kumar.ramesh5759@yahoo.com. Today we are discussing questions on admission of a partner. Although number of questions are objective, and I advise you that first you try to find the answer yourself. You write down the answer with you. I have given answer of these questions in the description part. Later on you can compare your answer with the answer which I have given in the description part and can assess yourself. However, question number 6, which is of comprehensive type, it has been solved on page 4 and working note of these questions have been given in the description. If you have any doubt, you can give me WhatsApp call or my mobile number, or you can write to me on my mail ID. Please don't keep any doubt with you. Always get the doubt cleared. Now we are discussing question number 1. If goodwill already existing in old balance sheet, it should be written off by debiting old partners in their old profit sharing ratio, trading count, balance sheet, trial balance, profit and loss account. Now the question 2 is, in case of undistributed accumulated losses, whose account should be debited? Undistributed accumulated losses. If the firm has suffered loss in the past and they have been accumulating, so whose account should be debited on admission of a partner? New partner capital account, old partner's capital account, gaining partner capital account, goodwill account. Number 3. What treatment should be given to implies provident fund appearing in the liability side of the balance sheet in case of admission of a partner? What is implies provident fund? This is the fund maintained by the business for employees. Some part is contributed by the employees and some part is contributed by employers. The total fund is kept with the employees provident fund office. When a partner leaves the firm, retires from the firm, he is given a lump sum amount by the employment provident fund office. Even during his lifetime, he needs money. He can take loan from his employees provident fund. Now Whether he asks when new partner is admitted, can they distribute it, or they cannot distribute it, or they can distribute it in equal ratio, or they can distribute as a part of reserve. Both treatment can be done. You have to give the right answer. Question 4th. A and B are partners in a firm sharing profit and losses in the ratio of 5:3. They admitted C as a new partner. The new profit sharing ratio between A, B, C was 3:2:3. New ratio is given. A surrender 1/5 of his share. He is not saying that A surrender 1/5. He says A surrenders 1/5 of his share. What is the share of old share of A? 5/8. So 5/8 into 1/5. So that is he is 5/8 into 1/5. How much it would be? 1/8. So A is sacrificing 1/8 and C share is 3/8. So 3/8 minus 1/8. It would be A's sacrifice, remaining would be B's sacrifice. Calculate B's sacrifice. We have to calculate it. Then we are coming to question 5th. Here you have been asked to give journal entries. 5th A. Amit and Vijay are partners in a firm sharing profit and losses in the ratio of 3:1. On 1/1/2019, they admitted Ranjan as a partner. On Ranjan admission, the profit and loss of Amit and Vinay showed a debit balance of rupees 45,000. Record necessary journal entry for the treatment of the same. Now it is debit balance of rupees 40,000. What is debit balance of? It is accumulated losses. This when a new partner is admitted, if they have accumulated profit, that is distributed. If they have accumulated losses, they are charged. So how will charge them? 40,000 in their old ratio, that is 3:1. So we will pass the entry Amit capital account debit, Vinay's capital account debit to profit and loss account. Amit capital account debit 30,000, Vinay capital account debit 10,000 to profit and loss 40,000. The narration will be given that debit and balance of P&L charged to old partners in their old profit sharing ratio. Then part B. A and B are partners sharing profit and loss in the ratio of 3:2. They admit C for 1/4 share of profit. C brings rupees 30,000 as capital and 1,000 as goodwill. 1 lakh, 3 lakh as capital and 1 lakh as goodwill. New profit sharing ratio of the partners would be 3:3:2. Pass the necessary journal entries. Now how much it is coming in the business? 3 lakh capital, 1 lakh goodwill. So cash account debit to C's capital, 4 lakh, for share of capital and goodwill contributed by C. Now C's capital account debit 1 lakh to A to B. A and B will be given in their sacrificing ratio. How we will calculate sacrificing ratio here? A sacrifice 3 by 5 minus 3 by 8. B sacrifice 2 by 5 minus 3 by 8. Whatever sacrificing ratio would be coming, that will be, we will distribute between A and B in that ratio. So 1 lakh will be distributed in the sacrificing ratio of A and B. And how will calculate sacrificing ratio? Old share minus new share. Old share of A is 3 by 5, new share is 3 by 8. Of B is 2 by 5, it is 3 by 8. Then part C. A and B who share profit in proportion of 5:3 had capital of 70,000 and 40,000 respectively. Their profit sharing ratio was A and B 5:3 and capitals were 70,000 and 40,000 respectively. They agreed to admit C into partnership for 1/10 share in future profits. C is coming for 1/4 shares. C brings rupees 30,000 as capital and is unable to bring rupees 1600 as a share of goodwill in cash. So he can pay 30,000 as capital. What would be the entry for capital? Cash account debit to C's capital 30,000 for capital contributed by C. Since he cannot bring this goodwill in cash, as they have taken him for 1/10 share. So for 1/10 share, his share is 1600. The total goodwill 1600 into 10 upon 1, 16,000. When a newcoming partner cannot pay goodwill in cash, goodwill account is raised. So goodwill account debit 16,000 to A's capital to B's capital. Goodwill raised to old partners only. So 16,000 will be distributed between A and B in the ratio of 5:3. So 16,000 into 5 upon 8, 10,000 and 3 by 8, 6,000. So goodwill accounts debit 16,000 to A's capital, 10,000 to B's capital, 6,000. Then we are going for D. Asha and Aditi are partners sharing profit and losses in the ratio of 5:3. What is the ratio of Asha and Aditi? 5:3. They admit Raghav as a partner for 1/4 share. Raghav brings rupees 6,000 as his capital and his share of goodwill in cash. Raghav is paying 6 lakh as capital and is paying his share of goodwill in cash. Goodwill of the firm is valued at 2 years purchase of the average profit of last 4 years. How you have to calculate goodwill? 2 years purchase of the average profit of last 4 years. The profit of the previous of the firm during the last 4 years are given below. 2013-14 3,50,000, 2014-15 4,75,000, 2015-16 6,70,000, 2016-17 7,45,000. The following additional information is given. An annual charge of Rs 56,250 should be made for the purpose of valuation of goodwill. For 1 year, it is 56,250. For 4 years, we will multiply by 4. The closing stock for the year ending 31st March 2017 was overvalued by 15,000. Stock has been overvalued. So they have shown it is loss for the business. So revaluation account debit to stock 15,000. Then 15,000 would be the loss. It would be distributed in Asha and Aditi in the ratio of 5:3. So Asha's capital account debit 15,000 into 5/8. Aditi capital account debit 15,000 into 3/8, whatever is coming to revaluation account. Then how much capital is paying? 6 lakh. He is paying 6 lakh capital and his share of goodwill in cash. Now first we will add the capitals of last 4 years. The last year 4 years profits are given 3,50,000, 4,75,000, 6,70,000 and 7,45,000. The total profit of last 4 years is coming 22,40,000. What would be the average profit? If you divide by 4, average profit would be 5,60,000. Now it is 2 years purchase. 5,60,000 into 2, 11,20,000. From 11,20,000, we are to charge, that is 56,250 per year. So for 4 years it comes 2,25,000. 11,20,000 minus 2,25,000, it comes to 10,73,750. See, since he is coming for 1/4 share, so 1/4 share is coming 2,23,750. So we will multiply by that and we will add the capital. We will be showing this in the working note. Now question 6. A, B and C were partners in a firm sharing profits in the ratio of 3:2:1. On 31st March 2019, their balance sheet was as follows. Balance sheet as on 31st March 2015. Liabilities. Creditors 84,000. General reserve 21,000. Capital accounts A 60,000, B 40,000, C 20,000. Total 1,20,000. The total of balance sheet coming 2,25,000. Now on the asset side, bank balance 17,000, debtors 23,000, stock 1,10,000, investment 30,000, furniture and fitting 10,000, machinery 35,000. The total is coming 2,25,000. On the above date, D was admitted as a new partner and it was decided that new profit sharing ratio between A, B and C will be 2:1:1. It means D is coming for 1/6 shares. Because the new ratio is given in the question 2:2:1:1. And their old ratio ABC was 3:2:1. The market value of investment was 24,000. On the above, investments are given for 30,000. Now its market value is 24,000. It means they have decreased with 6,000. Machinery will be reduced to 29,000. Machinery, before it was 35,000. Now it has been reduced to 29,000. Machinery has decreased by 6,000. Investment has decreased by 6,000. Machinery has decreased by 6,000. A creditor of rupees 3,000 was not likely to be claimed. The amount and has to be written off. That creditors will decrease with 3,000. So we have two entries. First, devaluation account debit, two investments, two machinery. Two investments 6,000, two machinery 6,000, total 12,000. Then creditors, Sunday creditors account debit to revaluation 3,000. If you see, there would be a loss of 9,000 will be charged from A, B, C in their own profit sharing ratio. A's capital account debit, B's capital account debit, C's capital account debit to revaluation. D will bring proportionate capital so as to give him 1/6 share in the profits of the firm. D's capital is not given, but he is coming for 1/6 share. So how we will calculate his capital account? First we will prepare capital accounts of the other partners. We are giving him 1/6 share. So balance share would be 5/6. Whatever their total capital is coming, for 5/6 it is this much, for 1 it is 6 into 5, and for 1/6 his capital we can calculate. Prepare revaluation account, partners capital account and balance sheet. Now first we are showing revaluation account. On the debit side, two investments 6,000, two machinery 6,000, total 12,000. By creditor 3,000, the loss is 9,000. By loss A 4,500, B 3,000, C 1,500. Total this much. Now partners capital account. A, B, C, by balance BD 60,000, 40,000, 20,000. These are given in the balance sheet. By general reserve, it is given in the balance sheet 10,500, 7,000, 3,500, 21,000 is the given general reserve. By D's capital 75, 7,500, 5,000, 2,500. Because whatever he will be bringing, we will cash account debit to D's capital, then D's capital account debit to A, to B, to C. The total is coming 78,000, 52,000 and 26,000. Then to A's capital in D 7,500, to B to C. Then the balance of A is coming 73,500, B 49,000, C 24,000. Total is 78,000, 52,000, 26,000. We will be showing the working note in description how he has calculated his D's capital. Then in balance sheet, capitals, you are given the capital balance 73,500, 49,000, 24,500, 29,400. Total is coming 1,76,400. Creditors 81,000. Total is 52,57,400. On a set side, previous balance of bank was 17,000 plus 15,000 plus 2,94,000. 29,400. Total is coming 6,14,000. Stock 1,10,000. Debtors 23,000. Investments 24,000. Machinery 29,000. Furniture and fitting 10,000. Total 2,57,400. So in this way we will be doing the sum. If you like this video, kindly like, share and subscribe it. But I once again remind you that you can For answers, you can refer to the description part. There, that is very, very important.